and its interest rates. This lecture we are going to give you an overview of what are the different financial markets and what are the different financial institutions and what are the different components of interest rates. Like we usually talk about interest rate, but what are the different ingredients based on which this interest rate is quoted. So we'll start with the markets or financial markets first. So in any economy, we find two groups functioning here. One are the suppliers of the funds, those who have surplus funds. They can be individuals who have savings in their bank accounts, and those savings are just there for meeting any emergency. So those are excess funds, those are surplus funds which are there, which are available, which can be used in the process of production. And then we have institutions which are collecting funds from the individuals, like banks. So now in commercial banks, the individuals keep their savings. Basically, their main objective is to keep it for any emergency purpose, and plus they can earn some extra amount on that. So these two institutions can provide the funds in an economy, like individuals as well as institutions. At the same time, there are people who are looking for additional funds, like if a person wants to do a business, so he might need funds for starting a business. So he is in need of funds. Individuals who want to use those funds for their business purpose, or maybe for their personal needs as well. At the same time, the funds are required by the institutions. Those institutions which want to expand their business or which want to utilize them to increase their productivity. So those are the demanders of funds. So there are these two groups always existing in an economy, suppliers of funds as well as those who are in need of those funds. Now, market is a place where the buyers and suppliers are brought together. When we talk about financial market is a place where individuals and organizations wanting to borrow funds are brought together with those having a surplus of funds. So, financial market is a place where those having surplus funds are brought in contact with those who are in need of funds. Now, in the books of finance, you will find different definitions of financial market, different types of financial markets. The distinction can be made based upon physical assets versus financial assets. Physical assets are like machinery, is an example of physical assets. So when you are buying or selling a machine in the market, that is where you are dealing with a physical asset. Financial assets are financial instruments like the bonds or shares when you are buying them in the market. So basically you are dealing with the financial assets. So that is one distinction. Then a distinction can be made based on the duration of your investment. Like if you are looking at short-term investment, then you are dealing with money market. Money market instruments are short-term investments. If you are looking for long-term investment, then you are looking for capital market. In capital market, financial instruments with long-term maturity are traded. So that is the difference between money market and capital market. Or money market instruments are short-term, capital market instruments are long-term. Though, like I described in the earlier lecture, when we talk about short-term, we usually mean those securities which have a maturity of less than 1 year. And when we talk about long-term, those securities which mature in a period of more than 1 year, those are long-term securities. Then another distinction can be made like primary market versus secondary market. Primary market is when the funds flow from the individuals to the organization. Once the organization issues their share, the public is purchasing that share and the money is going to the business organization. That is primary market transaction. Secondary market is where funds are exchanged between the individuals. So those exchange of funds is not affecting the company. The company has nothing to do with that exchange of funds. So example of secondary market is any individual buying shares from a stock market. Now the seller is selling, who can also be an individual or an institution holding the shares of a particular company, and the buyer can also be individual or can also be an institution who is interested in buying those shares. Then a distinction can be made in the financial markets based on the delivery of the goods. If the goods are delivered on the spot, like you pay for the goods and you receive the goods on the spot. That is spot market. A future market is where you pay on like paying on a certain date, but the goods will be delivered to you at a future date. So most of the time, sale of oil is based on this. Like you purchase oil and you pay in advance, but you receive the delivery at a future date.
other way around,
Like what?
जैसे जो है assets वो दे भी जाता है जो है payments.
That can be then it will be a credit sale. But in futures market, the delivery is due on a future date. What China did a couple of years back, China purchased steel based on futures, like from all over the world. They made purchase the deal with steel manufacturers all over the world. China did entered into contract with them, and as a result of those contracts, China saved a lot of money because they purchased in advance, so they paid a lower price. It happened that the price of steel all over the world went up, but China was at an advantageous position because they purchased in advance, they paid in advance, so they got the steel at a lower rate as compared to those who are paying at a later or purchasing at a later stage.
You pay today and you get the thing later?
At a future date. So that is the futures market.
It's because of the user requirement or by the compulsion, maybe problem at the other side.
It can be like
Because if somebody has got the material on shelf available, then why he go for a future date to deliver it? He knows it will be in today's society, today's environment, it will be costly after even a couple of days, even after a couple of hours.
So usually it happens where the things are manufactured on demand, not ready-made products. If ready-made products are there, obviously people will buy based on the spot. But if something is to be delivered at a future date, it needs some manufacturing process to go. So only in those cases. But in oil also it happens. Like the contract of oils, usually they are also based on future market. Like you pay today, but you will receive the oil at a future.
And what about if we use today and pay later?
That is a credit
like
sale.
electricity. The amount which is due somewhere in last year November we pay right now.
They are charging arrears. That is actually that does not happen anywhere in the world. It is only happening in our country. That you are paying for something that you have already consumed. That is unfair because the price should be upfront. It should be declared before entering into any deal. You cannot adjust a price at a later stage. Nowhere in the world happens like this. Another distinction of financial markets and the public versus private market. Public markets are where the rates are quoted for general public, like it is for everyone. Same rule applies whether you are buying individually or whether you are buying in bulk. The rate or the terms and conditions apply in general. But when we talk about private market, these are tailor-made transactions, like one-to-one transaction. So the terms and conditions vary depending upon the negotiation between the two parties. So that is a private market transaction. In public market transaction, it is general for all. It is the terms and conditions are standardized terms and conditions are there. But in private market transactions, the terms and conditions are tailored. They are based on one-to-one negotiation. So these are some of the different distinctions that we can make between different financial markets. Okay, now how this capital is transferred between the savers and the borrowers. One can be direct transfer. Direct transfer is like a company selling share directly to the public. So now in that case, the money is directly transferred from the public to the issuing company. So that is savers are individuals, or it can be institutions, those who are having surplus funds. It is in terms of savings. Like you have some money in terms of savings. Savings, the concept of savings. Now, investment banking house. Another concept is once you are issuing the shares, but the company is not issuing share directly to the public. Rather, there is some investment banking house involved. Usually what happens that once a company is willing to issue the shares, so they can hire the services of investment banks. Now, one bank can be there, it can be more than one bank. What they do, they purchase the share, that is called underwriting. So they purchase the share from the issuing company, and then that investment banking house sell those shares to the public. So the transfer is not direct, it is through investment banking house. Now the risk is transferred from the company to the investment banking house, because investment banking house pay upfront cost to the issuing company, so they pay the amount, and then the risk is now with the investment banking house. They can either earn some money on that, or they can lose the money. If there is gain or loss, it will be with the investment banking house. The advantage to the issuing company is they do not have the risk. They buy because they are getting the money upfront from the investment banking house. So that is transfer of fund in which there is some underwriter involved.
Current practice जो है वो यही है investment banks.
Most of the time the companies rely on investment banking because they two advantages are there. One is their effort is less. Somebody is buying in bulk from you, so you do not need to market your things, and you do not have to keep accounting record for each and everything. So obviously managerial effort is less, and secondly you are getting money in bulk. So upfront you are getting all the money in bulk. So that is most of the time, that is why the companies they prefer issuing shares through investment banks.
But once these investment banks they purchase those shares, then those shares basically become their property, and they can sort of put their own.
Yes, they can charge the money. They can put premium on it, or they can sell on discount. That depends upon their policy. But obviously, that becomes their baby. It is not with the issuing company anymore. And the last is through financial intermediaries. Transfer of funds through financial intermediaries. Simple example would be you are keeping your savings with a commercial bank. Now, the commercial bank, what they are doing with that money? Obviously, they are using it in different businesses. Either they are investing somewhere, or they are giving it on loan to someone. So, transfer of fund is taking place between the savers and borrowers, but there is some financial intermediaries involved, like a commercial bank can be there. It can be an insurance company. Same concept is there. Insurance companies, they collect the premium from the individuals, and then they use that premium for investment purposes in different projects. So these are the different ways in which.
So sir, how we will differentiate between, because in both these second and third cases there are intermediaries.
Right, but in second case there financial intermediary is only one, which is investment banking. In third case there can be it can be different. Commercial banks can be there. It can be insurance companies. It can be savings association, like we have these national saving centers. So they are also doing the same thing. So financial intermediaries can be more variety of financial intermediaries. Okay, financial markets we have already discussed primary and secondary. Primary is when the companies directly share to the public, or the easy way to understand is when the money is received by the issuing company. So that will be a primary market transaction. So issuing company, the company which is issuing the financial securities, that company is receiving the money. But in case of secondary market, the issuing company is not involved. It is between the individuals, like stock market. That is an example of secondary market transaction, where individuals are buying shares from the individuals or from institutions, those who are holding these shares. Now, whatever we discussed, the transfer of funds between the savers and borrowers, it is depicted in this diagram. You can see the topmost investment bankers, the savers are basically purchasing the shares from the investment banks, and then investment banks are providing it to the borrowers. Savers are providing funds to the financial intermediaries, which can be commercial banks, thrift institutions, investment companies, pension funds, insurance companies, or finance companies, and then again they are providing those funds to the borrowers. And the lower portion shows the secondary market transactions, where the money is transferred between the saver and borrowers through security exchanges. These can be organized exchanges. Organized exchanges are stock markets, and Over-the-counter markets are like we have this Nasdaq, concept of Nasdaq in US, where you can buy through online sources. So those transactions are secondary market.
What about this primary and secondary claims?
Primary and secondary, you can see in primary the money is going from the savers, it is going to the company, the issuing company is involved in primary transactions. But in secondary transactions, issuing company is not involved. The one which is issuing the shares, that company is not involved. Shares or bond, that company is not involved in secondary market transaction.
What about the claims? This is in the primary market, both of them. Primary claims and secondary claims.
Right. Primary claims, as far as the secondary claim is concerned, why is secondary claim? Why? Because first of all, the savers are providing money to the financial institution, and then financial institutions are providing it to the borrowers. So that is why, in that case, it is not. It is a secondary claim.
It's not directly.
Primary claims of commercial institutions,
Right.
and then commercial institution pays secondary claims to the savers.
That is why it's secondary. क्योंकि ऊपर एक जो लाइन लगी हुई है उसमें प्राइमरी डायरेक्ट जा रहा है borrower को, borrower से
Claims are yes, those are the claims which are actually if there is a problem, so आप वो claim नहीं करते कि there is a financial problem and there is some mode of protection between the two things. So primary claims are handled between borrowers and FIs, and secondary claims are those which are between those issues between FIs and the savers. These are those claims, the problems.
And if directly borrower has or saver has some claim from the borrower, then
It depends on the transaction. वो देखें ऊपर एक है. If saver is having something direct, the borrower, then there is no FI. But if
that is, it would be a primary claim then.
then it will be a primary claim from borrower to saver. But if there is an FI in between, then the primary claims are between borrowers and FIs, and secondary claim is between FI and savers.
So what does it mean? Stocks and bonds, for examples are given.
Primary
You
claims.
directly borrowers they directly take stocks from the savers.
The savers can purchase stock and bonds which are issued by the company. So that is
That is why the example is there.
that is why it is primary, because they are purchasing it directly from the company, issuing it. So in case of direct transfer of fund, it is primary claim. If it is involved some financial intermediaries is involved, then the primary claim is between financial intermediary and the borrower. But between the saver and the financial intermediary is the secondary.
So this
ये
Nasdaq
टाइप
type of
होती है कि ये जो पहली स्लाइड आपने दिखाई थी इसमें जो भी डायरेक्ट ट्रांसफर होती है इन्वेस्टमेंट बैंकिंग होती है वो प्राइमरी मार्केट होती है
Right.
और जो फाइनेंशियल तीसरा नीचे जो सिक्योरिटी
In a stock market, it will be more secondary.
और ये जो इन्वेस्टमेंट बैंक्स हैं इनकी व्हाट आर द एग्जांपल्स ऑफ दीस बैंक्स इन पाकिस्तान
पाकिस्तान में इन्वेस्टमेंट बैंक्स different, like Jahangir Siddiqui investment is there. It is a bank. It's a bank. Yes.
GS Bank.
GS Bank. GS Bank है. उसके अलावा जैसे अच्छा इसमें फिर ये होता है कि जैसे आइस बैंक ऑफ खैबर जो था उन्होंने अपनी जब इशू किए हैं शेयर्स तो उसमें अंडर राइटिंग जो प्रोवाइड करने वाले हैं वो मतलब दे आर मोर देन 3 or 4 कंपनीज वर इन्वॉल्व. अब उसमें कुछ बैंक्स में इन्वॉल्व हैं और उसमें कुछ इन्वेस्टमेंट
मतलब ये कि जो शेयर्स जो पब्लिक में आती हैं वो इन्वेस्टमेंट बैंक के नाम से
इन्वेस्टमेंट बैंक के थ्रू आते हैं.
और जो कंपनीज होती है वो इन्वेस्टर्स होती हैं
Savers होता है.
सेवर.
अब उसमें जो इन्वेस्टमेंट बैंक की जो फैसिलिटी प्रोवाइड कर रहा है बेसिकली उसको हम कहते हैं अंडर राइटिंग. वो अंडर राइटर कौन है? अंडर राइटर कैन बी वन और इट कैन बी मोर देन वन.
आप लोग ये भी शुरू कर देते हैं जैसे आप कमर्शियल बैंक्स हैं उन्होंने एक सेक्शन खोल दिया अंडरराइटिंग वाला. फॉर एग्जांपल लश्करी अगर है ये इन्वेस्टमेंट बैंकिंग के इलाका से वो एक अंडरराइटिंग के अंदर वो कर दिया है.
वही वो प्रोवाइड कर रहे हैं यानी एसपी वो भी प्रोवाइड कर रहे हैं इन्वेस्टमेंट बैंकिंग फैसिलिटी भी
वो
provide कर रहे हैं.
उसी के नीचे
अभी पाकिस्तान में Nasdaq की तरह की कोई एग्जांपल है? ओवर द काउंटर
नहीं
तीन वो
इंडिया वाली स्टॉक एक्सचेंज ऑर्गेनाइज्ड
तीनों ऑर्गेनाइज्ड
ओवर द काउंटर मार्केट वी डोंट हैव इट.
देखो सर एशिया में जापानीज वाला हैंगसेंग इंडेक्स है जो कि ओवर द काउंटर है और उसके इक्विवेलेंट नैस्डैक है यूएस में हैंगसेंग के अलावा और कोई नहीं है
हैंगसेंग
हैंगसेंग हैंगसेंग ये ओवर द काउंटर है इसके अलावा हमारे कोई नहीं वो भी जापानीज है हाँ जापानीज है
इंडिया में कोई भी नहीं है
इंडिया में
प्राइस बिग मार्केट है
the primary market savers are channelizing fund to borrowers. So household as a group are net savers, business and government as a group tend to be net borrowers. So funds are flowing from the savers to the borrowers. Okay, now when we talk about corporations, so what kind of securities they can issue? In corporations like those which are owned by the shareholders, they can get debt. What are the different type of loans they can get? They can issue mortgage bonds. Mortgage bonds are basically proof of your loan. You are getting loan for a long-term period, and you are issuing the bond. It is not price bond. Bond is a financial instrument which is issued by a corporation to the lenders, to the individuals who are providing those funds. Basically, that documents, it shows that what is the amount of the loan that the individual is providing, for how long it will be retained by the issuing company, and what is the interest the company is going to pay. So usually on bonds there is a semi-annual interest. After every 6 months they pay interest on those, and at the end of the period, whatever is the maturity date, like if it is for 5 years, if the bond is issued for 5 years, at the end of 5 years the principal amount is returned back to the lenders. Now, mortgage bond and debenture bond, there are two bonds mentioned here. What is the difference between these two? Mortgage bonds are secured bonds. They are secured, they are basically backed by an asset.
Property.
There is an asset which is pledged, so the company cannot
Exceed the limit.
no, they cannot use they cannot sell that asset basically. So that asset is pledged. It is now on the backing of those bonds. So they are secured bonds. Mortgage bonds are secured bonds. Why? Because there is an asset on the back. It can be a building, it can be a land, it can be any asset. So those are mortgage
That
bonds.
asset is by the company or by
Owned by the company.
by the lender?
No, that asset should be owned by the company. Because the company is issuing the bond, so basically company is borrowing. Company is providing this guarantee to the lenders. जनाब ये आपका जो पैसा है वो डूबेगा नहीं क्योंकि इसके पीछे ये asset है.
Maybe some gold is there or
Whatever it is. Usually it is a fixed asset, land or building. Then debenture bonds are unsecured bonds. There is no asset on the back. So that is the basic difference. Mortgage bond, there is an asset on the back end. And debenture bonds, these are also bonds, but there is no asset on the back. So obviously, if it is a debenture, the rate of interest need to be a little bit higher since risk is higher. Risk and return, both things are always there. So in mortgage bond, risk is less, so the rate of interest will also be a little bit lower as compared to debenture bonds. Then commercial paper is sort of written proof that the company has obtained a loan from any financial institution, and that once the loan is taken by the corporation, they issue that commercial paper. They issue a proof of that they have borrowed a certain amount of money for a certain period of time, and the rate of interest is such and such. So that is a commercial paper, loan based on commercial paper. And then lines of credit. Lines of credit is once you get approval from a certain bank or any financial institution that you can borrow up to a certain limit at any point in time. So you are not borrowing anything, but you are getting approval for that. Just in case of any emergency, whenever you have shortage of funds, you can use that line of credit. Line of credit is pre-approved loan for a company. So that is usually obtained by the company so that in any emergency situation, they do not have to go here and there. They have this approved line of credit, they can get money from there, and then they can repay on the terms and conditions which are there mentioned there.
and that money can be taken from any financial institution or from any person given?
No, it is usually from a financial institution, and the limit is described that up to this limit you can borrow at any point in time.
Generally, it would be a bank.
Usually it is a bank.
So this commercial paper is not.
Commercial paper is a written proof of, have you heard of IOU? IOU. So this IOU is basically IOU. Means you are giving somebody in writing that I have borrowed this money from you and I am responsible to return this money back to you. So this commercial paper is something in writing which is given by a corporation to financial institution from where they have borrowed this money, and it is a written proof of that. This is what.
In a way, bonds are also.
Yeah, bond is from the general public and also it can be from the general public as well. But commercial paper usually is from a financial institution. Bond you can issue to the public as well. So these are the debt instruments or the sources of debt for a corporation. They can issue bonds, they can borrow by means of commercial paper, or they can have an insured line of credit from any company that they can use in case of any emergency or anything. Now, as far as equity offering is basically once you are issuing the shares. So raising of funds can be of two types, debt and equity. Debt is borrowing, equity is from the owners. So the equity offering can be of two types. One is common stock, the other is preferred stock. The shares, basically, shares can be of two types. One are the common stocks and the other is preferred stock. What is the difference between these two? In common stock, the rate of dividend is not fixed. So rate of dividend is flexible. It is fluctuating. Rate of dividend is fluctuating. It is not fixed in case of common stock, but in case of preferred stock, it is fixed. So there is a fixed rate of dividend. In case of preferred stock. Secondly, whenever there will be a dividend, dividend is usually when the company is in profit. So if the company is earning some income or profit, the company is going to declare some dividend. So once the company is going to declare dividend, the preference will be given to preferred stockholders. So they are given preference. So if there is dividend, the company is declaring dividend, it is distributing dividend, so preference will be given to the preferred stockholders. So first of all, dividend will be distributed among the preferred stockholders. Whatever is left over, it is given to the shareholders. So surplus belongs to shareholders, belongs to common stockholders. Now, the dividend is fixed. For preferred stockholders, obviously they are going to get preference. So first of all, dividend will be distributed amongst the preferred stockholders. Whatever is left over, whatever is the surplus, it will go to the common stockholders. And another difference between these two is in case of common stock, we have the voting rights, whereas the preferred stock do not have voting rights.
This should not be the other way around, क्योंकि जो फिक्स्ड होते हैं वो तो ज़्यादा वैल्यूएबल होते हैं
किसके लिए?
क्योंकि उनको प्रेफरेंस देते हैं।
हाँ, प्रेफरेंस तो उनको दे रहे हैं, लेकिन उनको फिक्स्ड अगर दे रहे हैं उनको डिविडेंड, तो कंपनी बेसिकली द कंपनी इज ओन्ड बाय दीस पीपल. The main owners of the companies are the common stockholders. So that is why they are giving this voting right to the common stockholders. These are the ones who can elect the board of directors. These are the ones who are the real owners. Now, the preferred stock, not all the companies issue preferred stock. You will see most of the companies, they have only this common stock. But some of the companies, they can issue if they want. Now, again, it is not at the discretion of the companies, rather they have to get it registered. Once they are getting themselves registered with any government agency like CCP, now at that time they have to get this authorization, like how many shares of common stock they can issue and how many shares of preferred stock they can issue, if they can issue. So, each, but real owners of the business are these, the common
But
stock.
if they are the owners, but preference is given to the other individuals, is preference stock.
Right.
अगर उनको ही सारा profit चला जाएगा, then the surplus would be given to the owners.
So that is a little bit of a tricky thing here. Like if the profit is less, obviously, then everything will go
To the other people, and the owners they will not.
to the preferred stockholders. But if the profit is high, so then they will get less share, rather surplus is going to be with the common stockholders.
So how these stocks are, how they are differentiated with reference to the value?
No, type. Like they are defined as common stockholder is defined as a common stockholder. Common stock and preferred stock is defined as a preferred stock. Both of them are different type, and both of them have to be authorized from the government. They have to be, authorization is to be obtained from the government.
But their prices will also be different.
Price is will also vary.
So any example for the
Preferred stock?
for both of them?
Usually in Pakistan we have this common stock. Very few companies are issuing preferred stock.
What is the main reason, sorry, I was a little bit behind. What is the main reason of offering preferred stock?
Main reason is the company is in need of funds, so they want to generate funds, but at the same time they do not want to dilute their ownership. So the ownership is not diluted because they are not giving them voting rights. So that is the main reason, that is the main objective, that they want funds from the public. Another advantage is, okay, this can be another question, why not get debt instead of preferred stock? Because this has more or less features like of that of loan. There is a fixed amount of return which is in case of loan as well. So why not loan? Why preferred stock?
Maybe the rate of the would be lesser than the rate offered to the banks.
But if it is less, then public is not going to purchase those shares.
Interest में you have to give it, but इसमें तो dividend once you
That is the
get
main
profit.
That is the main objective. In this case, in that it is a fixed cost that you have to bear, whether you are on profit or loss. Irrespective of profit or loss, in case of debt you have to pay the interest. But in case of preferred stock, the key is you have to earn profit first. So if you do not earn profit, you will not declare any dividend. So that is the reason. So the reason for issuing preferred stock, rather than taking loan, is here the cost is not fixed as in case of loan. And
What if, excuse me, what if, since the rate of the dividend is fixed over here,
right.
and if the profit is less, the preference is given to the preferred stock owners, and if the profit is not that much, for instance, the profit declared is not that much, so that they can give to all the preferred stock owners the amount, the rate at which they have fixed, then what will you do?
Then they are not going to declare dividend. Dividend only the company is going to declare dividend once they have sufficient amount of income which can at least meet the requirements of this preferred stock.
Only then they will.
The board of directors is there who is going to decide. At the same time, they have to retain some amount as well. So they have to keep in view their future plans as well. So it is not necessary that they are going to declare or give away entire income in the form of dividend. They can retain that chance. Okay, so these are the basic different type of instruments, financial instruments that can be issued by the corporation in the form of debt. They can take debt by means of mortgage bonds or debenture bonds. They can issue commercial paper. They can obtain line of credit from a commercial bank or from any financial institution. And as far as the equity offerings are concerned, common stock and preferred stock are the two types of shares which can be issued. Okay, one term which you might have heard is IPO. Anyone any idea what IPO stands for? IPO is basically initial public offering. used, IPO is used once the company is issuing shares for the first time to the public. The term IPO is used. Like HBL was a state-owned, but then they decided to issue the shares to become privatized. Concept of privatization was there, so they issued the shares to the public, and the term IPO was used because their shares were issued to the public for the first time. So anyone who was interested in purchasing those shares, he can invest in those shares.
So all those shares which are given out the first time,
that is
they are
IPOs. Those are IPOs. And it is a sort of risky investment. IPO, sometimes people gain too much. And the example I gave you is not a very good example of HPL, because those people who bought the shares of HPL till now they are not able to recover their money, because it was very the price was very superficial price that they charged. So still people who bought those shares at that time, still they are not able to find that price which they paid. So IPO is a little risky. Sometimes you purchase shares at a very low price, and in this immediately first day or first week they rise up so much that you are multifold of what you have invested. But it can be other way around.
Isn't it as per rule that the IPO is to be offered at a fixed rate, which is
there is no fixed price,
right? I presume it used to be ₹10 for that fresh share.
That is face value. So face value, that is the price that you have authorized. You got authorization from the government once you decided to launch a company. So that is the face value. But you can sell the share, issue the share to the public at any price. It is not necessarily the face value. It can be a premium price. Premium price is you are charging 100 rupees for one share. It all depends upon the public, that what is the reaction of the public. If they are willing to pay, you can sell it. Again, if it is through underwriter, as usually happens, so it depends upon the underwriter, how they are going to market it and how they are going to charge the price.
In case of SPL, you are saying that it was
I think it was 10 rupees here and it was sold for 250 or 270 something.
The IPO
who was unable to recover. The government sold that bank.
Or HPL became privatized. So basically it was sold by the shares were issued by HPL or management of HPL. And the public, general public
purchased it. So they purchased at the superficial.
Premium, right? They purchased it
for
at
higher price.
Higher price. Like it was maybe close to 250 or something. One share of the price of one share.
So,
And right now, still it is not that price which you can find.
so who were at loss? The public buyer, but they were not at loss.
Right.
Risky for the public at least.
Right.
Not for the
not
for
for
the organization.
It is for investing in the IPO. Investment is done by the individual.
That is
Investing in the IPO is a risk.
It is a risk. Because it may go up, it may come down.
And it may go up many folds and it may come down many folds.
No.
So that is what it is. IPO is initial public offering once the shares are issued first time to the public. Seasoned equity offering, those shares which are already in public, already in the market, the company which is already dealing, their shares are already in the stock market. Once they are issuing the shares for additional, raising additional funds, so that is seasoned equity offering. That is the basic difference. First time issuing is IPO. If already shares are issued in the market, and then again the company is issuing some additional shares, that is seasoned equity. Which we have already discussed. Initial public offering is where a company issues stock in the public market for the first time. Going public enables the company's owners to raise capital from a wide variety of outside investors. Once issued, the stock trades in the secondary market, and public companies are subject to additional regulations and reporting requirements that we discussed in the first lecture. That the public companies need to have an annual audit, they need to have published their annual reports. So those sort of additional requirements will be there for public companies. There is an example. Apple computer decides to issue additional stock with the assistance of its investment banker. An investor purchase some of the newly issued share. Is this a primary market transaction or secondary market transaction?
This is secondary.
What if instead an investor buys an existing share of Apple stock in the open market? Is this a primary or secondary market? This is secondary, and the first one is primary. Why? Because the money is going from the public to the issuing company. So that is primary market. The first example is that of the primary market. The second, in which the involvement of company is not there, that is an example of secondary market.
इन्वेस्टमेंट बैंक जो बीच में आ गया वो फाइनेंशियल ऑर्गेनाइजेशन
लेकिन वो इन्वेस्टमेंट बैंक जो है वो पैसा तो पे कर रहा है बेसिकली, यानी उस इशू benefit of issuing that is going to the company. The company is receiving additional funds. That is why it is a primary market. Okay, now indirect flow funds from borrowers, which include different financial intermediaries, and these financial intermediaries are commercial banks, which we have many in our country, thrift institutions like saving associations, saving organizations. Like we have these national saving centers, they can be example of thrift institutions. Investment companies again, they are those who are providing funds either directly to the businesses or they are providing assistance in launching new businesses. Pension funds are also a financial intermediary because the money is deducted from the salary of the people, or usually what happens is that in case of pension funds, some contribution comes from the salary part of the individuals. At the same time, the organization contributed that fund, and then that fund is used for investment purposes. Insurance companies, they collect premium from those who are the member of insurance company, and they do business with that money. At the same time, those insurance companies, they provide the facility of settlement of claims, like whatever purpose of insurance is there, whether it is fire insurance, if it is car insurance, so they provide that service to the insurer, those who are the member of insurance. And then finance company, again, finance companies are those which provide loan facilities to the businesses. So these are all different examples of financial intermediaries.
Several examples of finance companies in Pakistan.
That is what
Normally, banks are issuing loans.
एक company है small business enterprise होती है.
Small and medium enterprise development authority or association, but it is basically owned by the government. SMETA is owned by the government. It is there to provide financial assistance, but it is for small businesses.
Small business.
So how to differentiate between finance companies and investment companies?
Investment companies are mostly they are those which are providing underwriting facilities. Those are investment companies. Finance companies,
Finance company को double charge.
that can be an example of companies.
The one who used to double the money.
So finance companies are getting money from the public, but they are not the bank. The difference between finance company and commercial bank is commercial banks are getting money from the savers, or they are providing the check facility, ATM facility. Finance companies are not providing those facilities, rather they are getting money from you for long-term purpose, and then they are doing investment.
Maybe we can do an internet service हमें पता चल सकता है कि यहाँ
ये वो assignment जो थी ना वो आपकी इसी के बारे में थी, which I it was supposed to be last week, but today we are going to have that assignment. What are the different financial intermediaries and financial markets which are operating in Pakistan? So you can find different examples of each of them. इसमें कोई इसमें आप
देखो तो मैं तो फाइनेंशियल
markets okay, maybe you can submit it next class so that you can include that part as well. Example of financial institutions or financial intermediaries. So it will become one assignment for everyone. Right? What this assignment? The assignment is that you have to find examples of financial intermediaries which are operating in Pakistan, specifically examples from Pakistani economy. And then financial markets, the examples of financial markets. Okay, here the definition of each is given. Something is not clear. Investment companies, here it is mentioned, mutual funds that pool savings of many individuals and investment in portfolio securities. They invest in a wide variety of primary means, including bonds and stocks. Mutual funds are set up to meet different objectives such as income growth, tax-free, international diversification, etc. So mutual funds can be example of investment companies. And as far as the finance companies, these are non-deposit taking institutions that specialize in consumer loans, commercial loans, and equipment leasing. So as I mentioned, they are different from the commercial banks, which are taking deposit from the public. They are generating their funds maybe through their shares. And then finance companies obtain funds by issuing their own debt claims and stocks. So that is the difference between these two.
आपकी लाइन का क्या समझ नहीं?
If they are not getting the, like, if they are not deposit taking institution, like they are not taking money from the public, so then from where they are getting the money? So they are getting the money by issuing their own shares and stocks, shares and bonds. That is how they are generating the funds, and then they are using that funds in commercial loans, in consumer loans, and equipment leasing. So these are the finance companies. I hope now the definitions are clear. Okay, what benefit is there of these financial intermediaries? The most important benefit is diversification. Now, instead of just investing at one place, we have so many different venues where you can invest the money. So you are not locked up in one industry or in one sector, rather your money is spread in different sectors and different areas. Secondly, expertise is there. That is the job of these people, those people who are working in these financial intermediaries. Day and night they are working with these numbers. And they know, again, the equation, lower risk and high return. So these are the people who actually deal with that. So where they know where the risk is minimum and where they can, the money will bring maximum return. Liquidity. Any idea what liquidity is? Liquid investment and frozen investment. What is the difference? The term used, frozen investment. Frozen investment is once you have invested, you cannot withdraw from that. Your money is locked there. Liquid investment is you can withdraw your money from that investment any point in time. So that is the great advantage here. You have purchased a share of a certain company, the company is not paying dividend or you are not getting your expected return. So you can sell that anytime in the market. So you basically have invested, but you have invested in a liquid state, like you can withdraw your money, you can get your money back anytime, any point in time.
If the shares are floated without an intermediary, even then the user has this
Right.
flexibility. So how come this?
No, the financial intermediaries offer you this facility where you can sell easily. Like you have this market, so you have all the time. You have those people who are looking for those securities. So that is the advantage. Liquidity comes from that point of view. Like you don't have to find yourself. Rather, people are looking for you. Who has this HPH share? Who has ICI share? So people are there who really keep on making this search. We want to buy those shares from those people who have these shares.
Doesn't liquidity actually mean the value at which that company or whatever organization you're talking about, if you sell it into the market at some point, that is the base value of that liquidity?
It is basically the opposite of frozen investment. Frozen investment versus liquid investment. So frozen is where your recovery is not possible. You have given the money, now you cannot get it back before that of time. Like if you have fixed term, if you have deposited money for fixed deposit, so that is sort of frozen investment. But in liquid investment, it doesn't matter. You can withdraw money, you can get your money at any point. Again, convenience. These financial intermediaries bring you this convenience of buying and selling. On just one phone call, you can find a broker and you can tell him that I have these many shares and I want to sell. He will find out buyer for you and he will call you back that okay, I have this offer for you, you want to sell. And on one phone call you can just sell your shares when you want to sell. And another thing is your risk management. Risk management is like these financial intermediaries are providing this option of risk management. Like again, somehow it relates with the first point, which is diversification. Like again, your money is not at one place, but it is diversified, so the risk is minimum.
And then the Investment Corporation of Pakistan, they had once I heard, I don't know how far they are going now, that you could open an account with them. They had a minimum level which you have to open the account. And then they would advise you that, okay, you purchase such and such shares, and when there was slight raise in it, they would give you a call, they would give the customer a call, okay, if you want to sell it, it's available to be sold. And your money remains with them, but they keep on, they claim that they keep on multiplying it.
Right.
And you can withdraw anytime you want your money from them. That is an investment banking concept, or
sort of it can be like, basically it is something like a mutual fund. They have older resources and now they are using those. They are giving you advice, so they are giving you financial advice as well, and they are maintaining your account as well. So dual purpose. Yes, sir. Because we have already discussed financial market, short-term money market is the one in which short-term securities are traded, those which have maturity of less than 1 year, and capital market in which long-term securities are traded. The examples, money market instruments, what can be different money market instruments? T-bills, treasury bills, these are the short-term obligations of US government in Pakistan. State Bank also issues the T-bills. They are issued with initial maturity of 13, 26 and 52 weeks. So pretty much within 1 year they are going to get mature. So basically government is getting loan for a shorter period of time. The return is less. Why? Because they are secured. Risk is less, so return is also less. Plus they are short term. Commercial paper, short term unsecured promissory note issued by large, well-known corporations and finance companies. Maturity range up to 70 days. So that is commercial paper, something that I already mentioned. IOU, that is an example. Checking account, deposit maintained by people and businesses with commercial banks against which checks are written. So short term. And then certificates of deposit, CDs, issued by commercial banks and advising the holder to receive the amount deposited plus accrued interest. So these are all money market instruments. When we talk about capital market instruments, corporate bonds, which are long-term debt obligations of corporations with maturity extending usually from 10 to 30 years. Interest is usually paid semi-annually. Treasury bonds, those bonds which are issued by the government. So those are called treasury bonds. Debt obligations of US government with maturities exceeding from 10 to 30 years. Interest is again paid semi-annually. So corporate bonds are issued by the corporations. Treasury bonds are issued by the government. But the features of both are almost the same. Common stock, which is the shares, common shares. We have already discussed the financial asset that provide an equity ownership stake in a business. Returns are in the form of dividends declared by the firm and capital gains or losses on the sale of the common stock. So capital gains or losses are once you sell your share. If you sell your share, if you have purchased the share for 15 rupees and when you are selling it, you are getting 20 rupees. So this 5 rupees will be a capital gain. If you purchase the share for 10 rupees, sorry 15 rupees and you are selling it for 10 rupees, so this 10 rupees loss is capital loss. So in shares, two things can be there. One is dividend, the second is capital gain. These two actions are there to invest in common stock. Mortgage loans, which are loans taken by an individual or firm to finance the purchase of real property using the property as security or collateral. And municipal bonds, long-term bonds issued by state and local governments to various projects such as new schools. So these are all the examples of capital market instruments. So main differentiation is in the maturity period. In money market instrument, you can see all of them are short-term, whereas in case of capital instruments, all of them are long-term instruments. Financial intermediaries, and then what are the benefits of secondary markets? Secondary markets, we discussed that these are the markets where already issued bonds and shares or financial instruments are traded. So what are the benefits of this? The biggest benefit is that of liquidity, and we have already discussed the concept of liquidity is that once you want to sell off your investment, you want to recover your money.
Savers point of view.
Again, yes, from the individual's point, savers point. Second advantage is efficient pricing and information disclosure. So, since we say that there are different forms of market efficiency, and usually the stock markets are claimed to be in strong form of efficiency, where all the information gets public very quickly. So people react to that information. So if it is a positive signal, something which is going on in the company towards the positive side, like it is going to improve the business, it is going to increase the profitability, so that positive signal boosts up the price of the securities. If there is any negative information about any company, so it will also be reflected in the sales price. So sales price is very sensitive. It is affected by the information, and that any information nowadays it gets public very quickly. The last one is efficient allocation of capital. Again, just imagine if there are no financial intermediaries, there are no financial institutions, what will happen that time? It will just keep lying in any bank account. There will be no productive output from that. So because of these secondary markets, this money is efficiently utilized. It is utilized in different projects, different businesses, and ultimately results in increased productivity and increased profits. So all of these benefits can be claimed for these secondary markets. Okay, our last topic for today is interest. Interest is any return or compensation a lender demands before agreeing to lend the money. So whenever there is any lending and borrowing, the thing that is negotiated is what will be the interest. How much extra amount the lender is supposed to pay on that. So it is a charge for the privilege of borrowing money. Whenever people agree to lend money to others, they take risk as a number of factors, and factors might prevent them from taking all their money back. This risk requires a monetary compensation that is referred to as interest. So interest involves different factors which we are going to see in the coming slides, that what interest rate is composed of. It is composed of different factors. Different factors affect interest rate. It is normally expressed in percentage terms, called the interest rate. Thus, if a person lends 1,000 to another person, rupees 1,000 to another person, and the return rate requires for the to rupees 100, we could say that interest rate charge is 10%. So, it is always not. Usually, it is stated per annum. So, interest rate is per annum. Like if it is 10%, so it means if you keep that money for 1 year, 10% additional you have to pay on that. So what are the determinants of interest? How interest rate is determined in an economy? The prevailing rate of interest in any situation is called nominal rate of interest. For example, in the above example, the nominal interest rate is 10%. The following are the components of nominal interest rate. The nominal interest rate is composed of real interest rate plus a number of premiums. This nominal rate, the rate which we find in the market, like if you go to a commercial bank and you say that I want to borrow certain amount of money, so what interest rate you will charge? So whatever interest rate they are putting there, that is nominal rate of interest. That is called nominal rate of interest. This nominal rate is composed of different premiums or different components. The last tower you can see is nominal rate of interest. That is composed of real rate of interest. Real rate of interest, if it is pure interest, like no other factors are involved. If you lend someone and you say, okay, I will get minimum this much from you. No other factor taken into consideration. So that is called real rate of interest. If you add inflation premium into that, it becomes nominal risk-free interest rate. Inflation, all the economies are facing this situation of inflation, and it can be determined that per year what is the rate of inflation in an economy. So that inflation rate is added to this interest rate, or real rate of interest. Real rate of interest, this inflation premium is added. Inflation premium is what is the rate of inflation in an economy that is added to it, and that becomes nominal risk-free interest rate. Why risk-free? Because we are not including any risk factor into it. It is only composed of two things: real rate, which is just the return that someone wants from his money, and then inflation premium added into it. Now, what are the different risks that can be there? There can be three types of risk which can be involved. One is maturity risk premium. Maturity risk premium is like if you say that you are going to return me after 1 year. I am giving you this 100,000 and you return me this 100,000 after 1 year. Now, after 1 year means now the rate I have to give, I am giving you this money, so I have to give you some rate of interest at that time. Let's say I tell you that okay, you pay me 10%. Now, this 10% is what I am charging against my money that I am giving you. What if the rate in the other outside, the rate which is offered by other people or other institutions is more than that, or it increases? Right now it is 10%, so I am also charging 10%. But after 1 month, let's say it becomes 12%. Can I change my rate of interest? I cannot change my rate of interest because I have given the rate of interest for 1 year. I have fixed that rate of interest for 1 year. So whether interest rate keep on changing or keep on increasing outside, I cannot charge extra. So that is a risk there that I am losing my return. I am just taking that percent. Whereas if after 1 month I give it to someone, I can get 12% instead of, I can get 2% extra. But I am losing that 2%. So I want to be compensated for that. So that is why this maturity risk premium is added. ठीक है, थोड़ा concept समझ आया कि वो एक risk तो है ना, वहाँ पे आपने पैसा तो दिया, लेकिन उस risk ये है कि ये शायद increase कर जाए rate of interest, जितने भी आप ले रहे हैं कल हो सकता है डबल हो जाए, तो आप तो डबल नहीं कर सकेंगे. तो आप basically there is a risk of losing some profit. आप उस risk को कवर करने के लिए क्या करेंगे? ठीक है, मैं जो आपसे नॉमिनल रिस्क भी रेट था उसमें 2% एक्स्ट्रा लूंगा to cover that risk. So that is one risk. ठीक है, maturity risk is basically the possibility of increase in the rate of interest during the period of loan. Second is liquidity risk premium. Again, problem. I have given someone money on loan for 5 years. So I cannot ask him to return my money before that. 5 साल के लिए मैं लोन दिया मेरा पैसा तो 5 साल के लिए वहाँ पे ब्लॉक हो गया. ठीक है, वही लिक्विडिटी का कॉन्सेप्ट. अब मैं उससे कोई और काम नहीं कर सकता. वो पैसा हो सकता है मुझे कुछ जरूरत पेश आ जाए. I am in need of that money, but I cannot tell that person to return that. Liquidity is pretty. What is that? Liquidity is once you can get your money back. That is liquidity. What is liquidity risk premium? Risk premium is I want to add into the I want to add this premium. Liquidity risk, I want to add this premium in the rate of interest. Like if it is 12%, I want 2% extra to be compensated for that liquidity risk. Liquidity risk is, मैंने जैसे बताया कि आपने 5 साल के लिए दिया था 1 लाख रुपए किसी को 5 साल के लिए दिया.
It is from the seller's point of view.
Sir, ये सारा कहते हैं कि
I was borrowing money.
No, देखिए जो lender है rate of interest उसने देना. रेट ऑफ इंटरेस्ट तो लेंडर ने कोट करना है, तो वो किस बेसिस पे कोट करेगा? वो सारे बेसिस को सामने रख के रिपोर्ट करेगा. तो लेंडर के पॉइंट ऑफ व्यू से बात करेंगे, वो ये कहता है कि जी मैंने तो पैसा दे दिया 5 साल के लिए, अब आई डोंट हैव दैट मनी अवेलेबल. कोई इमरजेंसी, कोई बेहतर अपॉर्चुनिटी मुझे नजर आती है जिसमें हो सकता है मैं डबल कमा सकता हूँ. दैट इज रॉन्ग बिकॉज़ माय मनी इज ब्लॉक्ड. सो दैट इज लिक्विडिटी रिस्क. एंड द लास्ट इज डिफॉल्ट रिस्क प्रीमियम. नाउ अगेन देयर इज अनदर रिस्क. आई एम लेंडिंग यू दिस मनी. Maybe after 1 year you become bankrupt. So what will happen to my money? there is a risk.
Difference between maturity risk premium and default risk.
Maturity and default. Maturity is the premium you want to get because of hike in the interest rate. ठीक है, वहाँ पे आप ये इस फैक्टर को मद्देनजर रखते थे कि रेट ऑफ इंटरेस्ट अगर चढ़ जाता है, बढ़ जाता है, तो मुझे तो उसका कोई फायदा नहीं मिल रहा, तो मैं उसको कॉम्पनसेट करना चाह रहा हूँ। और डिफॉल्ट में मैं अपने उस रिस्क को कॉम्पनसेट करना चाह रहा हूँ कि अगर बहुत डिफॉल्ट पैसे ना मिले, बंदा की डिफॉल्ट अगला बंदा जो है वो बैंकक्रप्ट हो जाता है, तो वो भी एक रिस्क उसमें। लोन में हमेशा क्रेडिट क्यों लोग पसंद नहीं करते हैं? बिकॉज ऑफ रिस्क कि उसमें आप बहुत अच्छे हैं, उधार अच्छा है, वाई? उसमें रिस्क है कि बंदा पैसे वापस करेगा ही नहीं करेगा, बंदा लेकिन पैसा ऑलवेज हैपेंस कि जब भी आप लोन देते हैं 100% रिकवरी नेवर हैपेंस। तो वो जो आपकी रिकवरी में जो एक एलिमेंट ऑफ रिस्क इज देयर, एलिमेंट ऑफ डिफॉल्ट इज देयर, वो आप कवर करना चाहते हैं, उसके लिए आप जिसको आप लोन दे रहे हैं उसका एक्स्ट्रा लेते हैं। तो जब ये सारे आप फैक्टर, when you add up all these factors, that become nominal interest rate. So nominal interest include maturity risk premium, it include liquidity risk premium, it include default risk premium, it include inflation premium, and it include real rate of interest. So all these factors combined becomes nominal rate of interest, or you can say market rate of interest. The rate at which you can get loan in the market, it is composed of all these factors. That was just to give you an idea that how interest is.
But are these rates internationally fixed?
No, these are not. These vary economy to economy and situation to situation.
There were some calculation formulas.
Again, this is nominal interest rate is a market rate, so it basically revolves something which is close to there is no standard formula, so that only inflation has a standard formula that what is the rate of inflation in the economy, that is standardized. All other factors are not. This depends upon it. Like default risk will be higher in economies which are very fragile type of economies in which fluctuations are too much. So those economies default risk will be higher as compared to those which are stable economies. Liquidity again is a factor.
All these regulated or they are
These are regulated by the State Bank of Pakistan. So, State Bank of Pakistan is there which governs the rate of interest as far as the financial institutions which are under the umbrella of central bank are concerned. But once we talk about private lending, that depends upon mutual. But standardized rates are applied where in Pakistan we have this Kaiwa, Karachi Interbank Offered Rate. That is the rate which is normally quoted. So this is the rate which is basically governed by the State Bank.
जो एक सूद की शरह मुकर्रर होती है हर साल, वो क्या चीज़ होती है? वो इनमें से क्या चीज़ होती है? वो नॉमिनल इंटरेस्ट रेट,
Nominal.
सबको मिला के होता है।
सब सारे फैक्टर्स टेकन इन
इस साल जो है वो 11.2% है या 12% है या 12 से बढ़ा के 14% कर दिया है।
राइट, वो दैट इज नॉमिनल।
बाकी आस्पेक्ट तो आपको समझ आते हैं, इन्फ्लेशन समझ आता है। रिस्क प्रीमियम जो है वो कैसे डिटरमाइन होता है? फॉर एग्जांपल इट विल वेरी डिफॉल्ट रिस्क है, ये कस्टमर वेरी
करेगा बिल्कुल। उसके मैंने कहा कि एक तो स्टैंडर्डाइज गवर्नमेंट की तरफ से या जो सेंट्रल जो उसकी रेगुलेटरी अथॉरिटी है, तो वो उनका अपना कोई क्राइटेरिया जिसके बेसिस को डिफाइन कर रहे हैं कि ये हमारा स्टैंडर्डाइज टाइप और ये है हमारा, दिस इज द स्टैंडर्ड।
ये तो लेटर में ही होगा ना, डिफॉल्ट रिस्क प्रीमियम को साइड लाइन में नहीं, इसे पैसा देना फ्रेंड साइड है।
हाँ एग्जैक्टली, मैं करूँ बिल्कुल फुल लेंथ। एक कोई मैं बता रहा है स्टैंडर्डाइज रेट है हमारे पास विच इज दिस। अब होता है क्या है कि जो मार्केट में आप जो बात कर रहे हैं इंडिविजुअल वेरी करेगा, उसमें फिर वो इसको ऐड कर देते हैं प्लस 4% अमाउंट। वो मजीद इसमें अगर वो समझते हैं कि इनकी दे गेट एक्स्ट्रा कॉम्पनसेशन तो वो उसमें ऐड कर देते हैं।
जस्ट लाइक दैट में क्या किसी को मनी दे रहे हैं, यू आर गिविंग 100 रुपीज, तो आप ये देखते हैं कि लिक्विडिटी देखते क्या है, मुझे वापस कर सकेगा ही नहीं, जब से करूँगा और कहते हैं कि चलो नहीं वापस नहीं कर सकेगा तो इसमें 10 की बजाय से 15% चार्ज करता हूँ।
हमारे तो नाम चीज़ आती है, फॉर एग्जाम्पल नॉमिनल रिस्क फ्री इंटरेस्ट रेट yield कर सकता है. Once it comes to risk premium, it will vary according to the case-to-case basis.
ये वही चीज़ है, वेरी है. प्लस जो लगाते हैं ना वो वेरी करता है, किसी को 5%, किसी को 8%, वो क्योंकि वो it depends on each other. Again, इस मार्केट में तो मार्केट has to be competitive. Market forces क्या हैं? Demand and supply हैं. But it has to be competitive. अगर आप if you are charging too much, what is going to work for you? It has to be some disadvantage.
ये assumptions नहीं है. अगर आप assume कर लें कि हाँ ये अभी इसकी working की अभी इतना मुझे कर सकता है.
Exactly.
तो इसको मैं 10 की बजाय मैं 9 से 12% चार्ज करता हूँ.
मतलब ये वो मैथमेटिक नहीं है कि मैक्सिमम इज 4, वो नहीं है. ये all these are based on different policy makers, depending on different situations और उसके ऊपर एक estimated figures नहीं है. Actual आप नहीं इसको कह सकते कि इसको specify करें.
So the interest rate offered by or issued by IBOR is the nominal interest rate or the first for nominal risk-free interest rate?
It is
IBOR, which they
as far as the government dealings are concerned, which or the institution which are governed by the state bank are concerned, then it is nominal interest rate. But once it is dealing with outside, like those which are not governed by the state bank, what they do, they add extra premiums. वो IBOR के साथ और उसमें ऐड कर देते हैं, IBOR plus 15%.
so it is risk premium plus another added premium.
वो जो जैसे अब आप गाड़ी लीज करवाने जाते हैं वो आप कहते हैं कि हम इतना
17%
वो इसमें 25% स्टेट बैंक हो सकता है 12% चार्ज करो, स्टेट बैंक ने उसको 12% डिसाइड किया, वो आपसे 17% चार्ज करते हैं, वो क्या 5% ऐड कर देते हैं.
मे बी वो इस तरह से है कि स्टेट बैंक से जो लोन ले रहे हैं उनसे तो वो 12% ही लेगा. वो अगेन जो मनी ले रहे हैं वो स्टेट बैंक से मे बी ले रहे हो और फर्दर आगे उससे वो जो भी चीज़ परचेज कर रहे हैं आगे जिसको वो दे रहे हैं उससे वो फर्दर 17% ले रहे हैं. दिस इज मे बी इंटरमीडिएट एजेंसी जो है वो दोनों तरफ कम्पनसेट कर रही है, जिसने किसी को पे करना है और जिसने पेमेंट लेनी है उससे
मिनिमम हुआ है और उसके ऊपर आप अपना
अगर स्टेट बैंक से कोई भी बंदा लेगा तो वो 12% पे ही लेगा, वो से का नहीं है, लेकिन बाकी फिर वो पेरी करेगा.
तो इतना में मिनिमम भी है इससे ऊपर.
सबसे इम्पोर्टेंट आस्पेक्ट इंटरेस्ट में दैट वुड बी टाइम.
टाइम फैक्टर को उससे आगे है, मैच्योरिटी में भी आ गया और डिफॉल्ट में भी आ गया कि मैच्योरिटी कितनी है, कितना टाइम पीरियड है, जितना टाइम पीरियड लंबा होगा ऑब्वियसली रेट ऑफ इंटरेस्ट बढ़ता है उसमें, क्योंकि ये दोनों फैक्टर्स में बल्कि तीनों फैक्टर्स ही आ जाएंगे. मैच्योरिटी भी उसमें आ जाएगा, लिक्विडिटी उतना सा पैसा भी काउंट हो गया, जितना सा लंबा है उतना सा लेटर अकाउंट है, उसका पैसा भी ब्लॉक है और डिफॉल्ट के चांसेस भी बढ़ जाएंगे, जितना सा बढ़ेगा जितना लंबा
short term loans are more expensive as compared to long term.
आप देखें ना टी बिल्स जो हैं जो आप स्टेट बैंक के हैं उस पर आपको क्या मिलता है, दे पे 3% और 4% और एज कम्पेयर टू दैट अगर आप फिक्स डिपॉजिट किसी के साथ करते हैं बैंक के साथ उससे 8% हमेशा उसका लॉन्ग टर्म वाले करेक्ट होता है क्योंकि उसमें रिस्क भी ज़्यादा है और
अच्छा. अब इसमें सर स्टेट बैंक का जो लोन है उसका 12% फिक्स रेट है, उसमें तो ये फैक्टर इन्वॉल्व नहीं हो रहे मैच्योरिटी वाले और
वो स्टेट बैंक के अपना
वो तो पर है ना, मैं अगर हम के एक साल में आपने इतना इंटरेस्ट लेगा.
हाँ पर रेट ऑफ इंटरेस्ट रेट पर है ना, मतलब डिफाइन पर है ना,
उसमें ये सारी चीज़ें शामिल नहीं है.
शामिल हैं उसमें, लेकिन साथ अगेन वो एक स्टैंडर्डाइज्ड हिसाब से उन्होंने अपने फॉर्मूले के हिसाब से
साल के लिहाज से किया हुआ.
अब आगे जो देने वाले हैं वो अपना उसमें फैक्टर्स देखते हैं जो
क्योंकि वो शायद देते ही साल के लिहाज से
नहीं, इंटरेस्ट होते ही मेजर पर है, किसी के पास भी आप जाएंगे वो जो कोड करेगा दैट विल बी पर है 8% है 12% दैट इज पर है.
तो स्टेट बैंक किसी को दे या अगला किसी को दे उसमें ये सारी चीज़ें देगी. स्टेट बैंक देगा तो वो भी नॉमिनल इंटरेस्ट रेट
राइट, लेकिन ये कि जो आगे देने वाले हैं वो रखते हैं और उसमें फैक्टर्स अगेन प्लस कर लेते हैं और ऐड कर लेते हैं उन्होंने जिस तरह से कैलकुलेट किया है दे वांट एक्स्ट्रा.
अच्छा अभी ये जो है दिस इज रियल रेट ऑफ इंटरेस्ट
नॉमिनल है स्टेट में
नॉमिनल तो तब होगा जब हम इसमें 4% ऐड करें.
अगेन वो फिर डिपेंड करता है जब बैंक टू बैंक फाइनेंशियल इंस्टीट्यूशन डील कर रहे हैं तो उनके लिए तो ये नॉमिनल है.
अच्छा
फाइनेंशियल डिस्ट्रीब्यूशन जो आउटसाइड जब आप किसी से डील कर रहे हैं तो फिर वो अपने और एड कर रहे हैं तो उसके लिए फिर हम
स्पेसिफिकली डील करते हैं इंटरबैंक ट्रांजैक्शन, क्योंकि जब डिफरेंट बैंक्स की डिफरेंट वेरी इंटरेस्ट रेट है, कुछ दे रहे हैं किसी के नेशनल सेविंग्स कुछ दे रहे हैं हमारे पास,
तो ये वो है जो वो बात करें 12% स्टेटमेंट वो है
वो इंटरबैंक सेम रहेगी। बाकी तो आपके बोरोवर की क्रेडिबिलिटी है, मार्केट कंडीशंस हैं, क्या उस वक्त प्रेशर है मार्केट पे तो ज्यादा लेने को तैयार हो जाएगा नहीं मार्केट।
अभी हमने एक कॉन्सेप्ट डिस्कस किया था पब्लिक मार्केट वर्सेस प्राइवेट मार्केट, तो ये प्राइवेट मार्केट में आ जाते हैं, यानी इसमें कस्टमाइज्ड कोई चीज़ नहीं है, एक स्टैंडर्डाइज कोई चीज़ नहीं है,
डील करेगा जहाँ पे वो फिक्स हो
आप
जाएगा,
वन टू वन डील करते हैं, बंदे की क्रेडिबिलिटी को देखते हैं, उसकी
बोरोवर भी देखेगा, लेंडर भी देखेगा, दोनों देखेंगे जहाँ पे वो सूट करेगा।
Ever that is fixed for all the banks interbank. So it will be independent of the bank rate.
It will be independent of
Bank rate.
बैंक रेट किसको कह रहे हैं?
Bank rating credit bank A plus 1.
अच्छा हाँ
Irrespective of that, the rate will be similar.
रेटिंग किसको है?
This person will get that.
वो जो है दैट इज सिमिलर इंटरबैंक एप्लीकेशन। Okay, yield curve. A yield curve is a graphical depiction of interest rates on securities that differ only in the time remaining until they are measured. So basically, what we do in the yield curve, we plot. Okay, this is a yield curve. Now we have yield, which is return on investment. Yield is return on investment, and maturity. So this shows the relationship between these two, that what will be your return on investment and as compared to your maturity. A normal yield curve usually is upward. So like the first one, you can see that as the maturity is increasing, the rate of return or your expected return is increasing. So that is a normal yield curve. As the time goes on increasing, the return also increases. The inverted is opposite of that. It is the yield keeps on decreasing as the maturity increases, and a flat yield curve shows that it is constant. As your time does not.
Examples is
It is like different economy. Normally, in all the economies, we have this normal type of yield curve. Like as long the more maturity period is there, the return should be higher. So that is the normal. That is. In the economies which are, you can say, where there is deflation in the economy, normally we have inflation in the economy. So inflationary economies, this is the normal yield curve. Inverted yield curve can be there in those economies where there is deflation. That can be there. Depends on the economy. And flat yield curve rarely happens. Never happens. That you go with the maturity. The longer the period is and the maturity of the return remains the same, that it usually has to be a normal yield. तो आपने बात की कि लॉन्ग टर्म जैसे जैसे जितना लॉन्ग टर्म होता जाएगा रेट ऑफ इंटरेस्ट आपका उसमें इंक्रीज करता है, तो इट मींस योर यील्ड इज इंक्रीजिंग।
नॉर्मली तो ये होता है कि जो आपने लोन दिए पर जिस तरह फॉर एग्जांपल ये कार लीजिंग वाला है टेक फ्रॉम बैंक, सो व्हाट हैपेंस इज दैट इनिशियली आपका रेट ऑफ इंटरेस्ट इज स्लाइटली हायर
जिसके शेयर ओनली पब्लिक के लिए अवेलेबल है। सो दोस कंपनीज आर सपोज्ड टू पब्लिश देयर financial statements in the form of annual reports. So they publish their annual reports, and in those annual reports they put all these financial statements together. So what is the purpose of preparing these financial statements? Obviously, the purpose is different. So since the purpose of each financial statement is different, the contents are also different. Balance sheet is a financial statement which gives us financial position of our business. Financial position of a business can be to check the financial position of the business. We can look at the balance sheet of a balance sheet is based on accounting equation that we discussed last time. assets are equal to liabilities plus owner's equity. So balance sheet is a perfect representation of this accounting equation. Different formats of balance sheets can be found. Like a table format is there in which we have two column table. Left hand side of the table shows assets and the right hand side of the table shows the liabilities and owner's equity. Whereas balance sheet can also be prepared in a report format. In report format, the upper portion of the balance sheet usually is assets, and then liabilities and owner's equity are represented on the lower portion of the slide.
Is there any line limit on the balance sheet or
It can be prepared anytime, but once we are talking about the publication of that, it should be on the last day of our financial year. In Pakistan, usually we have June 30th. So 30th June is the date on which we normally the businesses they prepare the balance sheet and publish that balance sheet.
but published balance sheet has to be audited?
It has to be. Before the publication, they have to get this certificate from the auditors. They give them this clear signal that okay, the accounts are properly maintained and there is no discrepancy in the accounts. Once they get the certificate, then they can. And that certificate is also part of that annual report. वो भी उसमें लगा होता है auditor की report है या उसका certificate है also. As I mentioned that it is usually it can nowadays what is happening, the accounts are all computerized, so there is no problem of generating balance sheet anytime you can prepare balance sheet. Normally those who are involved in the company affairs, they are interested in looking at the performance of the companies on monthly basis or quarterly basis, so they can ask for a published balance sheet at the end of the month or at the end of a quarter. So it can be generated any time. And once you look at the balance sheet, it always says this balance sheet is as on. So why it is like this? Balance sheet as on June 30th, 2011. So why it is as on? Because this financial position is changing on daily basis. The assets are changing, the liabilities are changing, owner equity is changing. So that is why it is always mentioned on the balance sheet that it is on that particular date that this balance sheet is.
Well, it makes a sense for the company limited because their shares are open in the market and the stock is going to be actually going to get excited. But why is it also the private limited?
Because their owners also invested in that. Secondly, two main stakeholders can be there. One is public, the other is creditors, those who are going to lend the money to them. So they are also interested in it. Like if a private limited company wants to borrow money from some financial institution, so they will be interested in looking at the balance sheet. They show us balance sheet for the last 2 years, 3 years.
Now the law says that even for any entrepreneur, not only private public limited, they need to have an internal auditor.
That is
For the FBR.
So that is for private limited companies?
For all the companies.
For all.
Singapore credit.
Okay, so now assets. What are assets? I hope everyone knows. Let's look at assets.
Inventory, cash in hand.
Net worth of the company. Net worth of the company.
Net worth to assets में तो minus करेंगे तो क्या है?
Cash होता है inventory होती है और security होती है.
Basically, these are your financial resources, economic resources owned by the business. So all the economic resources owned by the business are assets. What then classification of assets can be there like current assets and non-current assets. Current assets which are convertible into cash and सारे assets convertible into cash. लेकिन वो current हम इसलिए कह रहे हैं कि उसका purpose ही उसको हमने करना ही convert है cash. कोई भी asset आप बेचेंगे cash में convert हो जाएगा. लेकिन current assets are those which are intended to be converted into cash within 1 year. And non-current assets, they are intended to be retained for longer period of time. Retained करना है. Liabilities are your debts and loans, and again, current liabilities and non-current liabilities can be there. Those liabilities or loans which are paid within 1 year are termed as current liabilities. Those which are paid after 1 year will be termed as long-term liabilities. And owner's equity is the investment made by the company, owners of the company. When we talk about corporations, it is the shareholders' money. So you can say it is a share capital. So capital stock we do. ये जो कैपिटल स्टॉक सेक्शन आता है बैलेंस शीट में, इसमें एक तो कैपिटल स्टॉक आएगा. कैपिटल स्टॉक इज द मनी व्हिच इज रेज्ड बाय इशूइंग शेयर्स, और इसमें एक रिटेन्ड अर्निंग्स आता है. Anyone would like to explain what retained earnings are? अच्छा किसी लेक्चर में हमने कुछ डिस्कस किया था. नाम से कुछ लेना था. retained
सेविंग्स
earnings.
जो प्रॉफिट्स जो हो रही हैं, जो कंपनी अपने पास प्रोवाइड कर देती है, does not give to the shareholder.
That is it. तो वो भी आपकी, क्योंकि वो जो प्रॉफिट रिटेन किया गया है, वो also basically the money that belongs to the shareholders. या तो उनको देना चाहिए था, डिविडेंड उनको दे दिया, रिटेन कर दिया, तब भी ऐड नहीं कर सकते. So this section shows these things: capital stock and retained earnings. तो ये फाइनेंशियल बैलेंस शीट का पर्पस क्लियर हो गया. इट इज टू शो द फाइनेंशियल पोजीशन, और फाइनेंशियल पोजीशन आपको कैसे पता चलेगी? once you know that what are your assets and how much you owe to other people, कितने लोगों को आपने पैसा लोन या now income statement, another financial statement, and very important financial statement which is prepared by the companies. नाम से पता चल रहा है कि this shows income or results of operations. ये आपका प्रॉफिट होगा या लॉस होगा. So this statement is going to show you that whether the company earned a profit or there was a loss. इसको इसलिए प्रॉफिट एंड लॉस अकाउंट भी कहते हैं कुछ बुक्स में या कुछ आपको कंपनीज के अंदर. क्योंकि फाइनेंशियल स्टेटमेंट है, वहाँ पे इनकम स्टेटमेंट को जस्ट नाम प्रॉफिट एंड लॉस अकाउंट करो. इट्स द सेम थिंग.
This information which income statement gives cannot be determined from balance sheet.
No, because in balance sheet we have assets, liabilities, and capital stock. In income statement we have only two things. One is revenues and expenses. ये दोनों के contents different हैं. वहाँ पे financial position, we are interested in financial position, so the contents there are totally different. Now here we want to see what we earned. Revenues. What is revenues? How will we define revenue? Profits. Profit तो उसके बाद है. Revenue से expense minus करेंगे तो profit आएगा या loss आएगा. Revenue क्या होगा?
Whatever the company gets by giving out its products or
So
whatever.
you have that and we call as sales. Total sales आपका
Sales, yeah.
Revenues are basically your sales. अगर आप if you are a manufacturer or merchandiser, so sale of your products will be your revenue. If you are a service provider, so sale of your services. So revenue जो है वो या sale of good होगा या sale of service. Expenses जितने भी आपके जो costs आ रही हैं to generate your revenue, वो सारे आपके expenses हैं. So the difference of these two, revenue minus expenses, will give you net profit. And this income statement is usually for a particular period, as for the month of, or for the quarter ending, or for year end in इवेंट ड्रिवन भी हो सकती है। कॉस्टिंग में आ गई बेसिकली, जब आप कॉस्ट अकाउंटिंग में इवेंट ड्रिवन या ऑपरेशन से रिलेटेड उसकी आपने बोला, बट जो आप पब्लिश करने वाले हैं या शेयर करते हैं पब्लिक के साथ, वो नॉर्मली फॉर द ईयर एंडिंग पूरे साल का क्या रिजल्ट रहा, फुल ईयर में आपने कितने रेवेन्यू जनरेट किए, कितने एक्सपेंसेस है, नेट इनकम या नेट लॉस कितना है, और उसकी बेसिस पे डिविडेंड उसकी बेसिस पे डिसाइड करेंगे what will be the dividends that are to be distributed among shareholders.
One of the major difference between balance sheet and income statement is that it is linked to a certain period. There is no balance brought forward. Whereas the balance sheet carries the balance.
Right. That is a good point raised there. That balance sheet, those accounts which are there, assets, liabilities, and owner's equity. These are all fixed. Permanent accounts. These are all permanent accounts. Permanent account means they are not, their balance is not closed, rather it is carried forward. कि जो आपकी दिसंबर 31 की बैलेंस शीट थी, उसमें आपका जो कैश आया या आपका जो बिल्डिंग का बैलेंस आया या जो आपको उसमें जो भी एसेट्स थे, लाइबिलिटीज थी, जब आप जनवरी 1 को आप जाएंगे तो सारे बैलेंसेस आपके कैरी फॉरवर्ड हो जाएंगे, अगले पीरियड में ट्रांसफर हो जाएंगे। ये जो आपके हैं रेवेन्यूअल एक्सपेंसेस, ये सारे आपके टेम्पररी अकाउंट्स हैं, एक साल के लिए हैं, फाइनेंशियल ईयर के लिए। फाइनेंशियल ईयर क्लोज तक का काम खत्म हो गया। जब आप नया फाइनेंशियल ईयर स्टार्ट करेंगे, यू स्टार्ट विद जीरो रेवेन्यू एंड जीरो एक्सपेंस। सो दीस आर टेम्पररी अकाउंट्स, whereas the balance sheet accounts are permanent accounts. Their balances are carried forward for the next year.
So the income statement only talks of that specific period, right, for which it is being issued. Irrespective of उससे पीछे जो मर्जी हो, अगर जितना मर्जी प्रॉफिट हो या लॉस हो, जो भी है,
उस स्पेसिफिक पीरियड के लिए।
This will only talk for that period.
Okay, the last is statement of cash flows, and this statement shows the flow of cash. नाम से पता चल रहा है flow of cash. So focus is on cash. इसमें main focus in statement of cash flows is on cash. What are the inflows and outflows? कितनी cash business में आई और कितनी cash business में गई. So sources and uses of cash will be shown in this statement.
Transaction laws. Transaction laws.
Transaction
Laws.
laws. तो sources and uses, अब इसमें कुछ कैश हमने हो सकता है इन्वेस्ट किया हो कहीं पे, कुछ कैश हो सकता है हमने अपने ऑपरेशंस के अंदर यूज किया है, कुछ कैश जो आया है वो तो आया बेस्ड ऑन ऑपरेशन, यानी हमारी सेल्स से मेरे पास कैश आया, कुछ कैश हमने बोरो किया है या शेयर्स से किया। तो इस सारी इंफॉर्मेशन को समराइज करने के लिए व्हाट वी डू, वी डिवाइड दिस स्टेटमेंट इनटू 3 डिफरेंट सेक्शंस। आमतौर से जो आपको स्टेटमेंट ऑफ कैश फ्लोज मिलेगी, देयर विल बी 3 सेक्शंस। वन इज कैश फ्लोज फ्रॉम ऑपरेटिंग एक्टिविटीज, operations के नाम operating activities. So these are the cash that are coming basically from your operations, your revenues will be there. Then cash flows from investing activities. Again, if you could recall from first lecture, what are the investing activities? ये मुश्किल काम हो गया था एज के साथ साथ पुरानी बातें याद करके। इन्वेस्टिंग एक्टिविटीज प्रेजेंट है, डिस्कस किया था जब मैंने कहा फाइनेंस जो मैनेजर्स हैं they do the financing and investing decisions. They have to look into the financing and investing decisions. So investing कौन से decisions? What are those investing?
They spend their
Surplus
amount.
हाँ, surplus amount, right? ठीक है, तो ये investing activities वही हैं. Those which are those which are related to the left hand side of the balance sheet. So basically those which are related to the assets, acquiring of assets, selling of assets, buying of assets. ये investing activities basically are the investing activities वाली बात है. And the third section you will find in a statement of cash flows is cash flows from financing activities. Financing cash borrowing, right? ठीक है, तो वो जो ये दो स्टेटमेंट्स में आपको कुछ इन्फॉर्मेशन मिल गई. बैलेंस शीट में आपको फाइनेंशियल पोजीशन बता दी. इनकम स्टेटमेंट you became aware of your result of operation. Those results are further strengthened by this statement. Now here you can again look into it, what was going on in the business. What was the result of operations? What are the different activities, investing activities undertaken by the business, and what are the different financing activities done during that particular period. So again, a very good picture to come in front of the people who are looking for this.